Let's say you sell your business for $5 million. That's a huge milestone. And what most owners don't realize is this: depending on how that sale is structured, you could pay well over $1 million in taxes, or significantly less. Same business, same sale price, completely different outcome. Before we get started, I'm Mark Schreiber, CPA, Senior Partner at E3 Wealth, and show how different decisions made years in advance can dramatically change the tax outcome. Let's start with the most common situation. A business owner builds a successful company, receives an offer, and sells for $5 million. Let's assume their basis in the business is low, maybe close to zero. So the majority of that $5 million is treated as capital gains. Now layer in federal capital gains taxes, net investment income tax, potential state taxes. And it's not uncommon for the total tax liability to land somewhere in the range of 1.2 to 1.8 million, depending on the state. So the owner walks away with maybe 3.2 to 3.8 million after tax. Again, great outcome, but that's the default path. Now let's look at a different version of the same sale, same business, same $5 million valuation. But this time planning started 3 years before the transaction. That opens the door to several strategies. In some cases, business owners may be able to restructure how the entity is set up prior to the sale. That could influence whether the sale is treated as an asset sale or a stock sale, how gains are characterized, and how proceeds flow through to the owner. These decisions can have a meaningful impact on the overall tax bill, but they often require time to implement properly. Strategy 2, income timing and installment sales. Instead of taking the full $5 million in year one, the deal may be structured to spread payments over multiple years. This is called an installment sale. Now, instead of recognizing all the gain at once, income is recognized over time. That can prevent income from stacking into the highest brackets in a single year, potentially reducing exposure to additional taxes like net investment income tax, and creating more control over how income is taxed. When planning begins early, business owners can also take advantage of lower income years leading up to the sale. This can open opportunities to reposition assets, execute strategic tax moves, and prepare for the future liquidity event. Once the deal is in motion, many of these options disappear. So now let's compare. $5 million sale, $1.5 million in taxes, $3.5 million net planned ahead. Same $5 million sale, structurally reduced tax exposure, potentially hundreds of thousands of dollars saved. Not because of a loophole, but because the outcome was designed instead of reacted to. The biggest misconception business owners have is this: they think the tax outcome is determined when the deal closes. In reality, it's often determined years before the deal ever happens. Once you're negotiating a sale, you're working within the structure that already exists. If you're a business owner and you believe there's a possibility of a sale in the next few years, this is the time to start thinking about the tax side of that event, because the earlier planning begins, the more flexibility you have, and the difference in outcomes can be significant. If you'd like help evaluating what a sale might look like from a tax perspective before it happens, we invite you to schedule a conversation with our team. Because when it comes to selling a business, it's not just about the price you negotiate, it's about what you actually keep after taxes. Thank you.